Yeah, so this KB is the options KB, which we started from in the previous class, from the previous class. That's the KB stands for knowledge base. We may be using this term quite a bit. And so this is the knowledge base that you'll need for your options trading project. And you'll have some other knowledge as well, basic knowledge of options. So today we'll continue with that. This document. All right. Okay, here we are. We will. You can make use of all these links, and please start doing the readings so you get some basic knowledge. So we've covered this. I've divided this into small segments like this, where the title is in the middle of the page. So we did the definitions of derivatives. Definition options are a particular type of derivative instrument. Okay, other types of derivative instruments are obviously futures, futures, spot and cash and spot are not derivatives, but other types of derivatives. Here you should also remember two things you should remember when you think about derivatives. Just quickly wrap up here, just to wrap up. So you can see that we are studying options as a derivative product, so you should understand how we define derivatives. And for that, you can easily just go to the picture of that option pricing model, which I showed you. Simple calculator. Here you can see that the derivative product, which is here, okay, and this is this is further mechanically derived from the call option price, and this is one of the drivers of the model output. But there are other drivers as well. Okay, so you'll automatically understand the definition of a derivative product. We should also at the same time recap that, well, options are a derivative product, but there are other types of derivatives as well. Futures, forwards, swaps. And there are other types of, that's covered under forwards. I was talking about non-deliverable forwards and CFDs. Those are discussed in the note on asset classes, markets, and instruments, which was given to you in the previous semester itself, which we are continuing with, those markets basic notes. So these are the other types of derivative products. And in IFM, we will be doing, we'll be looking at futures contracts and swaps. And forwards, hopefully a little bit about forwards as well. Forwards and swaps will be covered to some extent together when it comes to FX. Okay, so options, derivatives, what are derivatives, what are the other types of derivatives, and also what are the common underlying instruments. Whenever you have derivatives, you have underlying instruments. That's why you have a contrast here between derivative markets and underlying markets. And so whenever you have derivatives, you have underlyings. And what are the common underlyings for derivatives? That, especially for options, when you can have any kind of underlying for options, okay? Spot, forwards, options, futures, swaps as well. So all of these can theoretically be options, underlyings for options, but most commonly these are futures and spot and forwards. Okay, these are the most common option underlyings. So aspects, we went into aspects of an option contract. I will try to put these kind of markers here to show where we kind of stop on a particular day. So don't get distracted by that. This is just for my marking so that we know where to take off from the next day. Okay, so what we discussed, one of the aspects of an option contract, obviously, is expiration date. You have to specify what the expiration date is in order for the dealer to give you the price of the option. Okay, the other type that you have to, the other feature that you have to talk about is the strike price. We briefly started on this, but we will revise this again today. So strike price, if you see the strike price, I think we also call the exercise price. I've called it a strike price, but it's also called exercise price. Okay, here you can see exercise price. So remember that an option is a call option. If you take the definition of a call option, and you can flip it around for put option. So the call option is actually an option to buy, and a put option is an option to sell. So buy what and sell what? And the answer to that is the underlying. Okay, so call option is an option to buy the underlying. Put option is an option to sell the underlying asset. Okay, or the underlying instrument. So as you can see here, if we go to our, we should move this a little bit closer. Yeah. That's right. Okay. So if we move a little bit closer, we can open. Yeah, what was I talking about? Strike price, exercise price. Okay, let's open this Yahoo Finance. So a call option is an option to buy, and a put option is an option to sell the underlying asset. Okay, at what price? Okay, because when you want to sell or buy, you will have to fix a price, and it is in standard options, the price is determined in advance. Okay, so it is the option to buy or sell the underlying asset at a given price. Okay, so that price at which you're contracting to sell, at which you're buying the call option or the put option to sell or buy the underlying asset, at what price? That price is the exercise price or strike price. So in short, what we have is, if we just go off here, I will just create a, let's just create, since MSFT is one of our tickers, we can just look at Microsoft options. So you have Microsoft underlying asset right now, the price, the market price is 213.25. We need to distinguish this from, so notice that when you're looking at, it's useful to use this option pricing model for our discussions, because then we can figure out which is which. So this 213.25, when you're pricing a Microsoft option, this 213.25 goes here, okay, in the underlying price. So this is basically this, yes, Siddharth, you have, so if we have 213.25, okay, we can put it here. All right, so this is where this will go, okay? And so this is the current price of the underlying. What you put in here is the current price of the underlying, okay? This is where you put the current price of the underlying. And what is the strike price? The strike price is the price at which I would like to buy or sell this particular underlying asset. With respect to the option that I'm buying, this is the strike price, is the price at which I would like to buy or sell the underlying asset. So that's why, so this is a different thing. This is the strike price or the exercise price. So I may be interested in 100 strike, or I may be interested in a 200 strike, okay? Something like that. So you can put in the 200 there, that's the price. You can put in any price that you want. You have to specify that and make sure we go in here. And so what we'll do is I'll go to options under Microsoft, and then I'll hyperlink this so that we don't have to come through this set of clicks every time. So in this case, what I want is, I want it here, option hyperlink, okay? So I'll just, I don't know why this color is, okay, so the colors come back, that's good. Yeah. Right, so we have this here, we can easily launch this every time from here. All right, so this is where we have this. So this is what we mean by the exercise price. So if you wanted to look at what the 200 call is doing, what is the price, the market traded price of the 200 call? This is the underlying price, the current asset price, and 200 is where we will just put it in straddle view. Okay, straddle view just means that you have calls and puts on either side, and the strike price is along the middle. So when you go to your option trader in TWS, that will also be a straddle view. Okay, a straddle is a particular type of option strategy where you either buy and, it's a long straddle is buy both calls and puts, and short straddle is sell both calls and puts. So those we will do later on when we get into option strategies. Right now we're understanding the basics of options. So 200 strike, you can see where the 200 strike, we can go down a little bit and see, okay, that's the one, all right? This 200 here that you can see, yeah, you can see this 200 here. That's what it is. So it's a 200 strike. So you can consider strike prices at various levels. Okay, here they have got a $2.50 interval. These things are usually set by the exchange. The exchange where these options are listed, okay, like the NSE or BSE or New York, in this case, I think CBOE, which is called CBO, Chicago Board of Options Exchange. I think now they just call themselves CBOE. So they decide these intervals. I mean, should it be 190, then after that 200, or should it be 197 half, 200? So that is decided by the exchange. And you can just look at the strikes that are trading, and you can see the different prices for the different strikes. Okay, and this is basically this is what it meant by the strike price. Okay, so if you're buying a 200 call, you're buying the right to buy the underlying asset at 200. Okay, when the current price is 213. Right, that's what it means. And of course, we looked at expiration date already yesterday. And as you can see, the reason this is this has a very low price is because the expiration date is very nearby. It's October 30th. If you choose a longer expiration date, if you choose, let's say, November 27th, okay, that will have a much higher price. They will update it. Now you can see the 200 call. Okay, it's 4.6. Okay, now you can see the price has changed from 0.7. So it's almost $4 increase in the price because we increased the expiration by about 3 weeks. So this is what strike price means. So in this case, in the 200 call, it is the right to buy. If you pay $4.60 per share, that means $460 per contract. Okay, where each contract on options is equal to covers 100 shares. Okay, so if you pay $460, you can buy an option to buy. You can buy a call option. Sorry, this is the put option. I looked at the wrong side of it. This is the call option. Okay, the call option price is much higher. It's $18.29. Okay, so you can pay $18.29. So it's basically if you pay $1,829. You can buy one contract on options to buy, which gives you the right to buy Microsoft at the underlying shares of Microsoft at $200 anytime between today and November 27th. Okay, that's what it means. So this is your meaning of strike price. And you already understand the expiration date from there. Exercise style is something. There are 3 basic concepts which relate to exercise style. Exercise style means when can you exercise? Remember, the option gives you a right. Okay, so whenever you have a right, you can exercise that right. Okay, so so the question is, when do you exercise that right, and how do you do it, and what is the nature of the true nature of the right? So we have 3 exercise styles: American, European, and Bermudan. Bermudan, you can remember as something in between America and Europe. If you remember your Bermuda Triangle and all, Bermuda is located between Europe and America. So this is one extreme, and the Bermudan is in the middle. So if you talk about, yeah, so you can see this here. I've written it here already. You can see what it means. So American style is any point of time. European is expiration only. Okay. And Bermudan is at specific points of time. So in this case, the options that you would be trading, these are actually American style options. Now this is again determined by the exchange. Okay, so there is a certain convention at every exchange, and generally there's a convention in the country itself. So in the US, for instance, equity options are individual equity options as well as the options on ETFs, which we'll be doing. Those are all American style. That's just a convention in the US. And the index options are European style. When you have index, yesterday Vipul was asking about index options. We don't have any direct index options. We have indirect index options in your project because your tickers include some ETFs for which are tracking certain indices. Like this is tracking the S&P 500. This is tracking the NASDAQ 100. This is tracking the Russell 2000. These are all indices, okay? But these are not index options because the ETFs trade just like individual stocks. So these trade like individual stock options. So these are American style options, okay? There are some direct options on the indexes, like the S&P 100 index, etc. Those are European style, but those are not very active. I mean, the index option, OEX is, S&P 500 index option is active, but the main activity in the US, if you look at total volume, the main activity in the US is all on these types of options, individual stocks or ETFs, and they're
Sir,
European style. Yeah.
sir, for example, there is also a stock called Dow, which is also an amalgamation of secondary sectors or the manufacturing sector kind of a thing, mixture of all several manufacturing industries. So is it similar to SPY?
No, no. Dow, are you talking about the Dow is the ticker for Dow? You know, there was a merger, Dow Incorporated, Dow and Dow Chemical, and what was the other company that merged? I forgot. We discussed it in the previous course. Dow Chemical merged with, I think it was, I'm missing the name right now, another massive chemical company, DuPont. Okay. So there was a big mess. So don't confuse the two things. Okay. Dow Inc. That is the symbol is with the ticker is Dow. This refers to a chemical company. You can read the details here.
Okay, sir.
There was a lot of confusion, and I mean, not confusion, but I mean, the companies themselves were confused because they merged these massive chemical companies, Dow and DuPont. Okay, these are both massive chemical companies. They merged, and then after I think a couple of years, they again demerged and they split into various businesses, kind of like what HP did. You know, HP broke itself up into HP Enterprise, which did the enterprise software, and then the printers division, which dealt with the hardware products. So in the same way, these guys then after merging, they demerged. Okay, so now it's a big mess. You have to figure out what is doing what, but I think it's still in the demerged state right now. So don't confuse this Dow. Okay, this is the name of the company because Dow Chemical is a very
That's
very
a Dow Jones, Dow Jones, Dow
yeah.
Jones,
So what Shaurya I think is talking about is the Dow Jones Industrial
Dow
Average.
Jones.
Okay, for which there is okay, there are two things. Okay, you have either you have in Yahoo Finance the syntax. Okay, this is called syntax. Remember, when you're programming, when you're learning programming, this is called syntax. How do you actually write this? Okay, so if in every software and every programming language has its own syntax. So in this case, Yahoo Finance is this web page is you can treat it as a piece of software, and it's got its own peculiar syntax. So if you want to look at any indices, the first thing is that caret. You have to put up the caret if you want to indicate any index. So that's why you see the moment I put up caret, all these things come up in the autocomplete. These are all indices. So what Shaurya is talking about is the Dow Jones Industrial Average. Okay, this is a very old industrial average. This is a very old stock index. Okay, just like your Nifty and BSE Sensex and all these things, the Nikkei 200, Nikkei 225, all these. This is an index, a very old index. It's got 30 stocks in it. Okay,
Yes, sir.
Shaurya, you were talking about this one, right?
Yes, sir. This industrial thing, as far as I remember, it was lots of industries with their secondary industry.
Yeah, yeah, but you have to be very careful, okay? You have to be very, very careful about the how you use words, okay? As I
Yes,
showed
sir.
you just now, the Dow confused me between whether you're talking to Dow, the chemical company, or the Dow Jones Industrial Average, okay? So you have to be very particular because you're a finance student, you're not a layman now. So you
Yes,
have
sir.
to be extremely particular about how you use your words. So if you're referring to the stock index, you have to say that I'm talking about the Dow Jones Industrial Average, okay? Or
Okay, sir.
if you just say Dow Jones, that's fine. But if you just say Dow, then it's a little confusing. Are you talking about the chemical company or are you talking about the stock index? Is that clear?
Yes, sir.
So let this be a pointer to everybody. Every time you speak about something in finance, you have to be very particular because that's why if you remember, I've told you whenever you're referring to euro dollar, the foreign exchange rate, you have to say euro dollar FX. because there is another product called the euro dollar, which is which is a interest rate futures contract. Okay, there's a euro dollar deposit also in the cash market, and then there's a futures contract on that. So if you just say euro dollar, then I will be confused. I will be a little confused. Are you referring to the euro dollar deposits? Are you referring to euro dollar interest rate futures? Are you referring to euro dollar foreign exchange rate? Okay, so therefore you have to be specific. When you say euro dollar, you must always say, if you want to refer to the foreign exchange rate, you must say foreign exchange euro dollar FX. So, right. So what was your question, Shaurya, about the Dow Industrial Average?
Is it similar to S&P 500?
Yeah, it is similar in the sense that the BSE Sensex is similar to the Nifty 50, and it is similar to the BSE 200 in the sense that they are all indices. Okay. Index, you understand what an index is? An index is just an average. Okay. So if I don't want to I don't have the time to look at everybody's grades in the batch, I can just take an average grade. Okay. I can give everybody an equal weight. Okay. Or I can give some other kinds of weight, whatever I can have any kind. I'm just taking a standard weighting scheme. So if I don't have time to look at everybody's grades in the batch, I can take a average grade for the batch throughout as you're progressing through semesters. I can look at, okay, what is the average grade for this batch? Okay. So the index is the same kind of concept. It's an average, and because you don't have time to look at all the stocks. S&P 500 has 500 stocks. The Dow Jones Industrial Average has 30 stocks. Okay. Nasdaq Composite, I don't know how many stocks it has. I think definitely more than 100. Okay. But there's Russell 2000, which has 2000 stocks. Then the QQQ, which you're doing, which is underlying for that, is it's tracking the Nasdaq 100. Okay. That has 100 stocks. So you don't have time to track all these stocks. So what this average or index does for you is it gives you an average of 500 stocks or 30 stocks. So yes, in that sense, if to answer your question, the Dow is similar to the S&P in the sense that it is an average of many stocks. Okay, it's a
Yes,
stock,
sir.
and that's it. But the composition is very different. Is that clear?
Yes, sir.
Composition is very different because the Dow is a very narrowly focused on index, and it's only got 30 stocks, whereas S&P 500 is much more broad based and has 500 stocks. Okay, does that answer your question? Anything else, Shaurya?
No, sir. Thank you, sir.
This is what it means. So remember to be very careful about the way you use your words. Okay. All right. We go back to this. Where will we? So we talk about exercise style. So it's a matter of convention as to where depends on where you trade. Like as I told you in the US, the convention is that the most of the equity options in the US are on individual stocks and ETFs, and that's where most of the volume is, percentage wise. Highest volume in those types of stocks, and those are American style. Okay, which means you can exercise it at any point of time. Although you will see any point of time means any point from the time you buy it to the expiration date. Have I gone to the? I thought I was in options. Okay, because I went to Dow, that's why I went back to the main summary. So we'll go back to Microsoft. And so expiration anytime, and we'll go for straddle view. Expiration anytime. It's not responding to my straddle view.
Yes.
Yeah.
Sir, we have two options, right? For options, we can either trade it, like buy and sell at a price and take profit, or we can exercise the option. Sir, the price change it is showing here is that the buy price of the option, and sir, also why when I was looking at options, why the spread is very even, like for 25 or 50 cents in this. And also, if we buy, do we have to like we have the lot is of 100 size. So do we have when we exercise the option, do we have to buy the 100 shares of Microsoft?
Yeah, I'll just address the last part of your question first. Okay. So the last part is, yeah, when you exercise, you will exercise in lots of one contract. Okay. So these prices that you're seeing, when you the how to read the prices. So I was talking about the expiration date. I'll just talk about exercise style once again, explain it. So if you buy any, let's say you buy the 200 call for Microsoft, it means you can exercise that call. First, you buy the call. Okay, so the way it works is like this. We take the 200 call as an example. We take the 200 call. I look at the expiration date of October 30th. So if you see now, we have locked in many of these aspects. Okay, what is the kind of contract? This number of contracts that will come to. Okay, as I said, this is why it's 0. So I have fixed this. I have focused on the call. What is the underlying asset? I have to take the underlying asset. I have to state it in terms of market instrument combination. So the underlying asset is spot. Okay, it's a spot instrument, and the underlying asset is the common shares of Microsoft. Okay, so the market is two assets in this market: common shares of Microsoft and US dollars. We are exchanging common shares of Microsoft against US dollars. Base asset is one common share of Microsoft, and terms asset is US dollars. Okay, so the price of the base asset in terms of the terms asset is 213.25. Okay, so let's get that clear. Let's go for basics. We'll make sure we understand the basics. So I'm talking about a call on this underlying as market instrument combination. The underlying asset is a market instrument combination, which is spot Microsoft common stock. Okay, spot contracts on Microsoft common stock. That's my underlying. Expiration date I have chosen. Okay, this is October 30th, but I'll choose November 27th because I want to go beyond the election. All right, and then I see that the 200 call has a price of 1829. Okay, this is where the last price is. Okay, and of course you have to actually trade at the offer price, but here because the market is closed right now, and anyway these guys don't show you bid and offer in this display; they only show you the last price. So let's assume that you can trade at this price. Okay, so 1829, I pay 1829 for the this is the expiration date we have set. The exercise price I was looking at a 200 call. In this case, we are looking at exercise price 200 call. The exercise style is American. Okay, I'll answer Siddharth's question, the rest of his question. I'm just making sure we get a good recap first. So strike exercise price is 200. We are looking at exercise style is American. What this means is that if I buy this, how will I buy it? I will pay, this price is per share. Okay, it's a per share price. And you have to remember, because you remember from your previous project, that the lot size in cash market equities, like these are derivative markets, the option prices. So the underlying asset is referred to as a cash market, even though those are actually spot contracts. So the underlying the convention in the spot market for Microsoft shares is one market lot. Market lot is 100 shares. Okay, so one contract in options for Microsoft or any of the US equity options, one contract is referring to 100 shares, covering 100 shares. So when you buy one contract, what you have to pay is 18.29 into 100. Okay, so for one options contract, it will cost you, not counting commissions, of course, 1829. So you pay 1829. They give you, so you do an exchange, you do a transaction where you buy one options contract on one call options contract on Microsoft with a strike price of 200, American style exercise, expiration date November 27. Okay, and for that you have to shell out 1829 US dollars. So the exchange that happens in a market, remember the market is a venue for exchanging assets. You receive one contract, one call options contract, you buy. Okay, you get that from the seller, and what you give to the seller is $1829. So the asset that goes out is 1829 US dollars. Okay, so this is basically, I just wanted to recap this so that you understand what's going on. And exercise style is American means that now you can exercise So what is this option contract given you? It's given you the right to buy shares of Microsoft at, in this case, to buy 100 shares of Microsoft because you bought one contract. Okay, you can change this here. You can increase the number of contracts. We are going to deal in terms of one contract to keep it simple. So you bought one contract. So this gives you the right to buy 100 shares of Microsoft at a price of 200, irrespective of at any time between now and 27 November. And this has no connection to, your right is now not connected to, once you bought the option, your right is not connected to what the price of this is. This can become 270, it can become 190, it can become 285, it can be anything. But at all times, you will have the right, up to this point, you will have the right to buy shares of Microsoft at 200, okay, at $200 per share. Okay, so sometimes it may be profitable for you, that right, and sometimes it may not. So that depends, but this is what it means. Okay, so American style exercise, you can do it anytime. European, I'll just explain exercise style before I come to Siddharth's question. If you want to talk about European style, you can only exercise, if it were European style, you would have been able to exercise this option, okay, to buy the shares at $200 only on this date. You can only exercise on this date, not before that. Okay, so that makes a difference. So that's the difference between European and American. And in the case of Bermudan options, what it means is that you can exercise it at specific points of time. So if you buy it today, maybe you have a Bermuda style option which gives you the option to exercise every Friday. So if you buy this Bermuda style option today, if it's a Bermuda style option, then you can exercise it on every Friday, which means you can exercise on every Friday, but not on Thursday or not on Monday, not on Tuesday, etc. So that's Bermudan, which is halfway between European and American. American, you can exercise anytime. European, you can exercise only at the expiration. And Bermudan, you can exercise at multiple points of time between the purchase of the option and the expiration date, but not at all points of time. That's why it says here, at multiple specific points of time. Here, this is multiple, okay? But not at any point. Any means basically it covers all, okay? But it covers specific multiple points, but not at any point. So you can put it here. This is the meaning of Bermudan options, okay? Exercise style. All right. Okay, now let's go back to Siddharth's question. I just wanted to finish the exercise style discussion. Yeah, Siddharth, sorry. You have to repeat. I was not able to follow the first part of your question anyway. The last part of the question that Siddharth asked was, yeah, if you buy, I think that is answered by what I have explained, that if you buy, you will buy 200, the 200 call, one contract, you have to shell out. This is a per share price. You have to shell out, not counting commissions, 18.29 into 100. So you have to shell out $1829, and they give you one call option contract, okay, with a strike price of 200, expiration date of November 27. Yeah, so I think this answers the last part of your question, Siddharth. Now, can you repeat the first part? I was not able to follow the first part of your question.
I was asking that there are two ways of making money in this. Like we can either trade the derivative, or we can exercise the right to buy the underlying asset, and then if we exercise it and then sell it at a higher price.
Yeah, you're correct. You're correct. So as you will see later on, at this point, we will just discuss exercise price. But as you will see later on, it is generally not remunerative to exercise early. Okay, so even though American style gives you exercise rights early on at any point of time, it is generally not remunerative to exercise early. So generally, the way when you're trading options, the way you would take profit is most of the time you would actually be selling the option itself, okay, because of a factor called time value, which we will get into later. But right now we're just studying exercise price. But you're right, there are two ways to make money. Either you buy, because notice that this changes in value, okay, this changes and the price keeps changing. Okay, so you could buy the call option at 1829, and then you might find after one day that the price is now of the call option itself is now 35.2. So you have jumped, the profit has gone from 18.29 per share to 35.2 per share. So you could suddenly just get excited. Okay, great, this is a great amount of profit. Let me book my profit. So you can book your profit by selling the option. Or as Siddharth is saying, you could buy Microsoft shares at 200 by exercising your option, and you find that the market price is 213.25, and then you may decide to wait and wait for the market price to go above 230 again, and now you're holding the underlying asset. Okay, you're long in the underlying asset, you would hold it, and then you think that this is going higher. So there are two basic ways to make money. Yeah, so he's right about that, but just remember this caveat already from now, that in general, as we will see later, that in general it is not remunerative to exercise early. So most of the time you will be actually booking your profit by selling the option itself. Okay, you will be booking your profit by selling the option itself, because as the underlying moves, obviously, along with other drivers, the option price will also keep changing, which you will discover when you get into your option trading. Okay, all right. Does that answer your question, Siddharth?
Yes, sir. Sir, and also I saw the prices for.
Your voice is on mute.
Sir, I was saying that I understood this, and sir, also why the bid and ask of the price is very evenly placed, like for 25 cents or 50 cents. Is that arbitrarily decided, or the market makers, like whatever happens, like in equity, it also happens here?
Yeah, that's a function of you're talking about the bid offer spread of the option price, right?
Yes.
Yeah, the bid offer spread for the option, that is a function of market liquidity. And there is, of course, one element of that, which is set by the exchange, which is what is called the tick size. So you can't go below the tick size. So for instance, in US equities, I think now they might have relaxed it. But when there was a previous regulatory change, the regulators or the exchanges will basically come up and say that your tick size is 1 cent, which means that if you change the price of this option, you can only go from 1942. The smallest move you can have is 1942 to 1943 or 1941. You can't go to 1942.5, and you can't go to 19.425. You can't go to 19.415. You have to go from 19.42 to 19.43 or 19.41. That's something that is a regulatory kind of a directive, or it is set by the exchanges. So that is kind of related to what is called tick value. Okay, the minimum tick size. Okay, so they determine what is the minimum movement you must have. So there's one element of that. Okay, so that is talking about what determines the bid offer spread. So one element is that, of course, that you can't get smaller than that. And the other element is what is called, is just liquidity. Okay, so you'll notice that if you follow it during US hours, active US trading hours, you follow the tickers that I've given you, then you will find the spreads are generally quite narrow if your expiration date is not too far out. If you generally look at within 1 month or 2 months, 3 months, the spreads are going to be quite narrow. Okay, so now if it's a question of liquidity. So the second aspect of what Siddharth is talking about, the second driver of the bid offer spread in option prices. Okay, so we can talk about this. Actually, maybe we can write this here. We will put it into the session notes so that I don't so we talk about which we have already discussed. Okay, so I'm not writing the answer here. Okay, and the second is the bid offer spread on options. It's a function of one, which is the regulatory So we can say regulators and exchanges, all right, they determine it. And then is also, um, so I'll keep these notes kind of very basic because it's really meant for people who have attended the class. So yeah, so one is bid offer spread on options is determined one by regulators and exchanges, and then also by uh, liquidity. Okay. So as you have higher liquidity, you will have narrower bid offer spreads. So that is a function of liquidity is a function of the underlying asset. Then it's a function of the expiration date. Okay, where most people will have interest is in generally 1 month, 3 months kind of time frame. So although in the US you will have more activity in long-term options than you will get in India, which is one of the reasons why I'm making you trade US options, not Indian options, because the liquidity is much more. Okay, so yeah, okay. So yeah, Siddharth, does that answer your question?
Yes, sir.
Okay, all right. So so we were discussing essentially what we are trying to make sure we understand is aspects of an option contract. What are the various aspects? Like you walk into you tell your assistant, let's say, I want to buy a vehicle. Now that's not specific enough. He's going to ask you, do you want a two-wheeler? Do you want a four-wheeler? Then if it's four-wheeler, do you want an SUV? Do you want a sedan? What brand do you want? Okay. So all kinds of things. All right. So if you do you want autopilot, if you're buying a Tesla, these kind of things. So you have to specify many things before the salesman understands exactly what product you're looking for. In the same way, you have to specify if you just tell an option market maker that I want to buy an option. That's not enough information. You have to give him more information before he can actually quote you a price, okay, which is meaningful. So that's what we are dealing with here, that when you're talking about an option, you have to specify many aspects. Okay, so these are the various aspects. And additionally, the option pricing model requires, this will be supplied by the market maker, a few other inputs. Okay, volatility, interest rates, and the expected yield. Okay, so I have written this in a very general sense as yield, and so dividends will be one type of yield. You notice many of the option pricing formulae, because they focus on stocks, so they will directly write dividends. But the more general way to write that is to talk about yield. Okay, because the dividend is the yield on the underlying asset. If it were actually a bond, if the underlying asset were a bond, then that would be the coupon rate on the bond. Okay, so so that's basically what you have to write down. So you can see here there are, in addition to this, is normally these are specified by the customer who is asking for the price on the option contract. These are specified by the customer, and uh, these are input by the dealer, okay, the market maker who is pricing the option, because these things are available in the market. This information is available in the market. And so you can look at this. We'll just talk about a couple of conventions here in terms of how we are going to refer to it. Okay. We are going to talk about volatility. I'm not going to use this big word every time. I will just call it vol. Okay. Vol means volatility. Now, vol, we refer to two types of vol. We have H vol and I vol. Okay. So H vol is historical vol, and I vol is implied vol. Okay. So these are, so again, I'm not going to use these very big words, historical volatility, every time. I will just say H vol and I will say I vol. Okay. So every time I say that, you should remember implied volatility. At least here we can write this properly. All right. So you have to understand the difference between, so these are conventions that we are going to use to save myself time. I will just say H vol and I vol. You have to understand what these are. We will talk about later, but these are two different things. Okay. And so you have to understand every time I say H vol, you should hear it as historical volatility. And if I say I vol, you have to understand it as implied volatility. Okay, this is what we have. As you can see here, you can relate this to the pricing model, that these three have to be entered by the dealer. You can go to the pricing model and you can see what are we looking at: vol, interest rates, and yield. Okay, so you can see it here. It's a stock option pricing model. So it's got dividend yield, it's got interest rate, and it's got vol. All right. So this you can see, this is entered by the dealer. These inputs are coming from the market maker, from the customer. Okay. So well, the underlying price is also entered by the dealer because he can see what the underlying price is. Okay. The customer specified what the underlying asset is, and the dealer will just look up the price. So this is what we have. Any questions here up to now, other than H vol, I vol? I'll explain what that is. Okay. Let me put this. Put some of these actually here. We can put it into our notes. Okay. All right, we have that. I have to make that. Okay, never mind. We've got this here. Then we have something else. I vol charts 1. I will take this out also. And let me just open this. In the meantime, let me take it here. And I vol charts, let me put it here. I'll fix this up later. Yeah, now we're talking about I vol charts. Now, what I say, I'll explain this. Yeah.
Another question, sir, unrelated. Sir, can we use options, this as a indicator for getting the market sentiment? Like if there is uh, a, a very high trade volume of call options rather than put options, then can we say that the underlying asset will, the investor's attitude towards a particular security is that it will move, the price will move higher, so they are buying more options?
Yeah, so you're what you're talking about. I might have mentioned it somewhere down in my notes. Maybe I've not talked about this put call ratio as an indicator of potential. What Siddharth is talking about is put call ratio. Okay, we refer to as put call ratio, but it really should be called put call volume ratio. Okay, as an indicator of potential direction of. Let me save myself some writing. So what Siddharth is talking about is put call ratio. Actually, it should be called put call volume ratio, but the market refers to it as put call ratio as an indicator of potential direction of underlying asset. Okay, so that's what he's talking about. So the short answer to Siddharth's question is asking whether we can use this as an indication of, because this information you can get from the exchanges. Okay, what is the ratio of put volume versus call volume? Okay, and this is actually what is called a contrarian indicator. Okay, so high call volume will be relatively high call volume is generally seen as a bearish indicator because small investors. They are supposed to be, kind of stupid, I guess. So they're buying calls a lot. That means that the market is likely to be topping out. Okay, so that's the kind of indicator. The short answer is as a contrarian indicator. This is a and the short answer to Shraddha's question is that, like many other things in the market, many other theories in the market, this is not 100% reliable. Okay, this is kind of true for almost everything. Okay, so yeah, you can use it. There is some logic to it, but this is not 100% reliable. Personally, I would not. I think you should just know it. You should be aware of it, because if you go into industry, people will talk about these kinds of things. So you should know what they're talking about. But I would tell you straight away that this is not something which is very reliable. Okay, so therefore you should not actually rely on it. You can just look at the information. But if you want to have a simpler trading system, this kind of thing need not be a part of your trading system. You can have a much simpler trading system, which simplicity has a great value. Okay, yeah. Does that answer your question, Sada?
Yes, sir.
Okay. All right. So we have. I was just copying from here. So this is essentially what we are talking about in this whole module that we are still discussing. Aspects of an option contract, which is basically before you price an option, what is it that you need to enter? Okay, essentially we're talking about the inputs to an option pricing model. That's what we're talking about. Okay, so some of the inputs come from the customer who wants the price, and some of the inputs are put in by the market maker. Okay, so we will discuss what H-vol and I-vol is later on. We'll get into that discussion. But at the moment, for the moment, you understand that they're two different things. And the fact that they're two different things can be seen from this chart. This is which option? This Oracle. We can change it to something we are looking at. Microsoft. Okay. You can see here options. They don't have the 27 November part. So this is a very basic display style, site. Okay, so you can see this. I'll just make this. This is too big actually. 125 is better. And so you can see here, and then you can also see the what happened. Where happened? Okay, because now this is the ball chart. Okay, so you can see 1 year of the data range is 1 year, but you can see that the blue line is H-vol, and the orange line is I-vol. So there are these are two different things. There is obviously a close relationship, but that does not mean that they are the same. All right. So you have to understand that these are two different things. What they exactly are, we will come to later. Okay. But you have to understand for now that these are two different things. So that covers this particular module. This is what you have to enter into this. These are the inputs to the option pricing model, and the output is this, and then the put option is derived mechanically from the call option price using a relationship called put call parity, which we will hopefully have time to look at. Okay, that's an example of a no arbitrage price. Okay, and no arbitrage pricing rule, which determines put call parity. So yeah, so let's look at, so these are some of the payoffs and all that. This we can look at later. But let's go on to the next module, which is, now we have already covered decision problems. Okay. So we are going to look some, when you're talking about options, there are some additional decision problems. Okay. So we are going to look at that. Right now we are only just going to list it. Okay. And let me see. Okay, so the other thing, we will come to this. So when you are doing option trading, okay, there are two approaches. All right, so let's make this full. You have to understand this. This is what you guys are going to be doing, okay, in your project. We are going to train you to be trading like this as directional speculators in option prices. Okay, so this DS is directional speculating. So remember that all the notes are continuous notes. These three subjects that you're learning are all, the material is all continuous. So whatever you covered in IPM, you have to remember all that, and you have to be able to use those concepts. These are, DS stands for directional speculator. MM stands for market maker. Okay, all this theory is in your notes. If you have any problems, you have to ask me. So there are two approaches to option trading. Okay, one is buying, selling options only, all right, which is what directional speculators do. As I explained in response to Siddharth's question, in general, even American options, you don't in general exercise them early. You sell off the option itself. If you want to take profit, you sell off the option itself. You don't exercise it early. So what you're doing is you're buying, selling options. So this is directional speculation in options. Okay. So this is the kind of trading in options that you guys will be doing. But there is another kind of trading which you should be aware of. We will briefly discuss further detail when we go to the detailed part of this. We will look at that again. But you have to be I'll just highlight this, otherwise everything gets highlighted. There is another approach to trading options, which is what option market makers do. Okay, which is, this is what option market makers do. They may sometimes trade buying, selling options as well. Okay, therefore I should write this as also. But what they're doing is they're dynamically hedging their risk through trades in the underlying market. Okay? Underlying market in this case means, here the options are options on Microsoft common stock. So a Microsoft options market maker will be sometimes maybe buying and selling options as well, but he will also be very actively buying and selling the underlying asset, okay, to balance the various risks. We will discuss this, but these are the various risks that are thrown out by an option pricing model. So mainly he'll be managing the gamma risk, gamma and delta are connected actually, and the vega risk. For that he'll be buying and selling options. But the main point to understand is that the option market makers do something which directional speculators in options do not do. The DS people, what you guys are going to be doing, they are only buying and selling options. They do not touch the underlying market. In fact, in your project, you are also forbidden from doing trades in the underlying market, because I want to train you in a pure way to trade first as directional speculators. So the way you get trained is, first you get trained to do this, and then you get trained to do this, which we will not have time for. Okay, but as a second phase, you would have been trained to do this kind of dynamic hedging. Okay, which is what market makers do in addition to buying and selling options. So that's what would happen. So you should be aware of it. Okay, but we are not going to be training you to do this because we don't have the time. Okay, so you are going to be doing this, but you should know that there is another approach to trading options. Okay, so all right, so let's look at this. Sometimes let's put this second. With our discussion. So you guys are going. So when you do going to the somebody tell Gagan to mute. Okay, I can mute him. Can I mute him? Yeah, I can mute him. Great, great. Oh, I didn't know that actually. That I didn't realize that I can mute people. Okay. All right. So what we are doing now in this module is we are going to look at some additional decision problems that arise in option trading. And because we are using this expression option trading, we have to clarify that there are two approaches to option trading. There is the approach that is followed by directional speculators in options who will only be buying and selling options. Okay, they will not touch the underlying asset. They will not do any trades in the underlying market. That's one approach. But there's another approach which is followed by market makers. Okay, they will dynamically hedge their risk not only by buying and selling options but also by doing trades in the underlying market. Okay, so this is a second approach we will not be looking at. So when we are listing out this, we are not listing out decision problems for the dynamic hedging scenario. We are only listing it out for this first type of approach to option trading. Okay. So let's go through our decision problems once again. We looked at the decision problems, general decision problems in managing an investment fund. And you are already familiar with that, okay, which is available to you here. These are the decision problems that we discussed, okay. Now what happens when you trade options? You have some additional decision problems. So let's look at these. Okay. These three are solved by the investor mandate. Okay, that is clear. Now let's just go to the investor mandate. Let's go to number 5. Okay. Underlying market is solved by this part, second choice of market. Instrument is options. Okay. So in this project which you're doing, asset class is equities. Markets are these particular tickers, only these 20 tickers. These are your markets, underlying asset, underlying market instrument combination, 14 stocks and 6 ETFs. 20 tickers, these are your 20 markets. In each of these markets, you're trading stock of Bank of America against US dollars, ETF XOP against US dollars, stock of Facebook against US dollars. These are your markets because the market is a venue for exchanging one asset for another. Okay, so those are your markets. Then whether to buy or sell options. Now this is where the additional problems come in. Okay, in the case of options. Now whether to buy or sell. This is you're already familiar with this DP being decision problem. You already know this. This is our DP4, right? Now, having solved DP4, okay, you have another thing that you have to solve is whether it's call or put, okay? So, in fact, what we can do is, but I've listed it like this, so it's okay, but you can also list it as 1.1 because having solved one above, okay, maybe I can indent it a little bit. Yeah. So 2, 3, 4 actually are kind of connected to one. There are sub problems under one. Okay. When you decide whether to buy or sell, okay, you take this decision. This is already coming from our earlier list. This is our DP4. And so in the case of option trading, you will take a decision whether to buy or sell options, whether you want to be a buyer of options or you want to be a seller of option in that particular market. When you're looking at, say, Microsoft options, do you want to be a buyer of options or a seller of options? So you take that decision, okay? You'll see that that's how the decision gets taken. Then having solved that, then you have to solve the question of, are you going to be, let's say you chose, in this case, let's say that you decided to be a buyer of options, okay? Now the question arises, Because remember, if you just go to the dealer and say, I want to buy an option, that's not good enough. He is going to ask you, do you want to buy a call or a put? You'll have to tell him that. So you have to additionally, this is where we are talking about additional decision problems in option trading. So I've listed out everything from the beginning, and some you can see are additional. Okay. Now the dealer is going to ask you, are you going to buy, you want to buy a call or a put? So you'll have to decide this. Okay. Let's say you decided to buy a call. All right. Just for example, for the purpose of discussion, I'm just making an arbitrary choice. Now, that is also not fully, I mean, it's not completely answering all the questions and all, it doesn't solve all your DPs. Then the dealer is going to ask you which expiry date. I'll just highlight expiry. Okay. So let's say you choose, you want to buy options, then you want to buy call options on then you're looking at Microsoft options, and you decide to be a buyer of options. You decide to buy a call option. You decide that your expiry date is November 27th. Okay, that is also not so. Now the dealer is going to ask you, which strike do you want to buy? Okay, because as you can see, when you look at the call side for the expiry date, there are many strikes. Many strikes are trading. As you get closer to the, most of the activity is in the around the current market price of the option. These are called at the money. We'll look at that this definition later on. But you'll see that in most of the pricing software, when they show you the quote software, the option quote software, they will have this kind of shading. So the shading is around the price where the price is right now. Okay, it's 213, so they put it at 250. So they will have this kind of shading. We'll explain what this means later on. But you can see activity here. This is the volume. These are the volume numbers, and these are the prices. So you can see that there are, if you just look at November 27 Microsoft calls, there are many strike prices. So the dealer is going to ask you, which strike do you want? Then you have to tell him that. So you have to choose a strike. Once you choose the strike, then you are done. Okay. Let's say I choose the 200 strike. Okay. Now we know what the price is. It's 18.29, the market price. Okay. So that's why we say additional problems, because clearly you can see that in connection to your DP4, okay, in connection to DP4, there are some additional problems in the case of options. You have to choose between call and put. You have to choose the expiry, and you have to choose the strike. Okay, and all of these are decision problems. Okay, I'll give you a framework for how to solve these decision problems, but you have to understand that these are all decision problems, right? So this is basically what I mean. So what we are learning now is, we talked about decision problems in the previous course. We understood the decision problems in managing an investment fund. But now that we're talking about trading options as directional speculators, we have some additional problems to solve, additional DPs. And these are the additional DPs. Okay. Now, as entry price, you are already familiar. Okay. The same logic, entry via market order, stop order, or limit order. Okay. There's no change in that. For option trading also, you can use any of these. Okay. That discussion does not change, but that's a decision. We're listing all the decisions. This is not an additional decision. It's an old decision problem. Now, number 6, number of units to buy, sell. That's also an older discussion. We've had that discussion. And number 5, there's an additional decision, which is exercise style. Okay. This is also additionally, so what we can say is, let's solve let's put this, we'll put this in the additional decision problems we are highlighting here. Which are the additional decision problems? So we can make this like this. Those which are additional, we are highlighting. What is truly additional? Call, put, expiry, strike, and here. Exercise style, maybe I should make this all right. So this also is an additional decision problem technically, but this, what happens is, the reason I've said it's solved by the investor mandate, because remember where this comes from, okay? This, whether or not the options are American, European, or Bermudan, these are actually decided by the market convention, okay? So in the US, for instance, equity options are, they are European, American style. This is just a convention. Okay, like in India, we drive on the left-hand side of the road. There's no big deal. I mean, if you go to the US and you drive on the right-hand side of the road, you're still driving. So it's not a big deal, but it's just a convention. Okay, so this convention is set by the market in which you're operating. Okay, and since the investor largely determines which market you're operating in, okay, in this case, I am your investor, and I have forced you to trade only in US equity options. So if I'm not letting you trade Indian equity options or Japanese equity options, so because I've forced you into a particular market, which is what investors will typically do, either directly or indirectly, and every market has its own convention. So you don't really choose the exercise style so much directly. You choose the market, and then the market itself determines the exercise style. Okay, so you can choose to learn driving in India or in the US. You will still learn how to drive, but if you choose the US, then you will learn how to drive on the right-hand side of the road. Okay, but you still know how to move the car, which is what driving is all about. So this is not so important, and it is automatically determined by your choice of market, because the market convention determines it. But it's important to understand that this is a additional decision problem, because when you're talking about aspects of an option, you have to talk about the exercise style. All right. So these are the additional decision problems, and as you will see, so when we give you the go through the KB, you will see that the focus of the KB is, of course, there's a little bit of basic options knowledge you have to have. Otherwise, you can't operate as an option trader. But otherwise, the focus will be on giving you a framework, just like I gave you a framework in the previous course on solving the generic decision problems, like how many units to buy and all that. So I'll give you frameworks for deciding these problems, to solve these problems. How do you solve these problems in a logical way? All right. So we'll be going through that. Now, there are some additional decision on the subject of additional decision problems in option trading. Let's look at, so we continue that after you buy initial transaction, okay. Okay, so after you have decided to buy, sell the call or put, there are some additional decisions that Siddharth was mentioning, was alluding to. Okay. I'll just highlight liquidate option. This is understood. Okay. So to liquidate option here, you can talk about either early access. Let me not highlight this. Let's just only talk about the sub problems. Okay. So the question is, early exercise, this is the real decision problem. This is what Siddharth was referring to. That if you buy, especially if you have American style options, obviously early exercise, this problem will not exist in the case of European style options because I just put. Yeah, okay. So early exercise does not, um, this question mark should be here. Obviously, this arises only in the case of American style or Bermudan style. It does not arise for European options because you're not allowed to do early exercise. Okay, exercising the option means exercising your right to buy or sell the option before the expiration date. Okay, exercising is early exercise. That's what it means. Now, this is the other side of that. This is the basic. Uh, Let me call this square. So these are. This is your decision problem. You can obviously 6.1 and 6.2 are mutually exclusive. Okay, so this is your decision problem. You have to choose between 6.1 and 6.2. You have to choose between 6.1 and 6.2. Right. So this is what Siddharth was referring to, that once you buy the option, so if you buy the 200 call on Microsoft and it expires on November 27th. So between now and November 27th, as you see the movement happening in the underlying asset price, and also you'll have to follow the eyeballs. We'll come to that later, how you do that. But let's say at the moment you understand only the underlying asset price, you buy the 200 call, you have the right to buy here. As the market price moves around, maybe it shoots up after the election to 240 or something. And then you have to take a decision. Should I do early exercise and buy the underlying asset? Or should I sell off my call option in the underlying in the option market? Okay. So as I said, in general, you always choose 6.2, but that does not mean that you never choose 6.1. In certain cases, you may have, it may make more sense to do the 6.1. But when we are discussing the theory, we should look at all the theoretically possible alternatives. Okay, so that's why I'm listing both of them. Although in general, as I said, the early exercise is not an option, is really not optimal. Okay, so we'll just write that in, maybe just to as a, you'll see that maybe we don't have time to cover early exercise. So I'll write it even for American options, obviously. I think we have covered it actually. So in general, you don't do it, okay? But you should be aware that as a general theory, that technically that option does exist, okay? That alternative does exist. So you should be aware of it, okay? So this is the additional decision problem that you have to solve, okay? As I said, generally it is always solved by generally. Why do I say in general? Remember how to use the language. Written communication is very important, and that also is connected to your oral communication. Now, if 6.2 was always the right choice, then I would not put in this kind of phrase. Remember how you should write. Okay, there I was cautioning Shaurya just now in the early part of the class. Be very particular, and that's when I caution somebody. It is not just against him. It's just not meant to be a criticism or anything, and he should not take it personally. This is meant for everybody. Okay, so it's a general warning to everybody to how to correct your way of thinking. If it was always true that 6.2 is the right choice, then I would not put in this expression. I would straight away write this. But why am I not writing this? Because I want to hedge myself. I want to protect myself. Because there are certain situations where it may make sense to do early exercise. They're not very common, but they do exist. Okay, and they can exist. That's why I am protecting myself by putting in this hedging statement in general, so that when somebody points out to me certain situations where 6.1 makes sense, I will say, well, what did I say? I said in general, which means there can be some exceptions to this statement. Okay, so remember to write like this. When you write, okay, based on the situation, when this is required, you have to put it in. Okay, so then 6.2, 6.2a and 6.2b. Now this should not be 6.2, should be 6.3. Okay, because this is already 6.2. This you already know from before. These are old problems. Okay, exit with loss, exit with profit. These are old problems. These are not new problems. So the new problem is actually, the additional problem is this: whether to do early exercise or whether to square the option position in the market. All right. So, and remember, these are only for doing directional speculation in options by buying, selling options only. Cannot touch the underlying asset. These additional problems are only for that situation. Okay, so you should be aware. If somebody asks you, what have you learned, you can say we learned about these, but we did not learn about dynamic hedging by market makers. So you know that it exists. It's like you know that there is a country called Korea, although I have never visited it. Okay, so in that sense, so there is market makers that have to do dynamic hedging, and that includes certain additional decision problems, which we are not going to be covering. We will briefly introduce it later on for you, but we will not cover it. Okay. Okay, so I've given it here already. This you can read up on your own later, but they have some additional decision problems, market maker decision problems, which we are not going to be covering. Okay, so I'll put this entire thing in italics. And maybe I'll give it a different font. To make it look different. Okay, so we have covered these. All right, so we've covered our initial transaction. We have covered the additional decision problems. So we are going through various modules. So I have listed it here for your own knowledge. Okay, those of you who want to study further, that you can just look at it, but we are not going to be covering it. But you should know that they exist. Okay, now in the industry, we use this term called OPM, option pricing model. Actually, this is not correct. Okay, it's not a pricing model, it's actually a valuation model. So you understand the difference between price and value, which we have discussed before. Okay, it's actually a valuation model, but now you can't correct industry habits. As I said, you have to learn at two levels. You have to learn the industry lingo, the industry jargon, and in many cases the industry jargon may not be correct. It's not theoretically correct. So since you're doing an MBA, you have to also know what is the theoretically correct term. So when you discuss anything like this, where there are two dimensions to it, you should know the industry jargon. At the same time, you should know what is the theoretically, you should understand why that is not correct. and what is the theoretically correct statement. So you should understand both. Okay, you have to learn at two levels. So why is this not correct? Why is it actually a option valuation model? Or should be OVM, okay, not OPM. Why is that? No, we'll come to that. If you remember, okay, we had talked about get it full here. Yeah. So price and value. Remember price and so we'll continue this. Okay, guys. So your class is dismissed. We'll continue. We'll start in the next class. We'll start from here. So maybe I can put my ticker over here. Yeah. Anybody has any questions? The rest of the class is dismissed. And those who
Sir,
have
I have an issue actually, not a question actually. The issue is that I logged in yesterday around 9 o'clock. Unfortunately, I forgot it around 7:30. So I logged in around 9 o'clock. But still, like the same issue persisted. Like this app thing, I didn't really get what it means actually.
what is happening? The update.
Yes, sir.
Okay. What is happening? Your system is not logged. So the rest of you can leave. We are just discussing his problem. So you're saying you're not able to log in.
Yes, sir.
So did you have a problem with your password? Have you changed your ID and password?
No, sir. I have sent it to you right now on your phone, just right now.
Don't send me stuff on the phone. I hate using my phone. Please, when you communicate with me, please try to use email. I hate using even though I have an 8-inch phone, I find it too small. So I hate using my phone. Anyway, it doesn't matter. You sent it via WhatsApp.
Yes, sir.
Okay, fine. Another request for you. Don't use WhatsApp. I don't look at my WhatsApp every day. So if you have to contact me, just give me a missed call or give me a SMS. WhatsApp is not a preferred method of.
Yes, sir.
Okay. All right. So yeah. So what we can do is anybody has. Okay. Let me come to Shaurya's question a little later because it's not really a technical conceptual question. Anybody has any kind of conceptual question or technical question, then I'll stop the recording actually at this point. Anybody?
Yes, sir. Sir, who writes these options? Is it decided by exchange, or can any investor write these options which are traded?
Arya, you just wait. I'll answer your question after I finish all the technical conceptual questions, okay? Because then
Yes,
I'll
sir.
stop the recording. Just wait. Yeah, so question by Siddharth is who writes these options? These are just like any, so the option market is like any other market, okay? So there's a market for options, okay? Just like you have a market for spot. Now in the previous project, you were operating here, okay? Intersection of equities and spot in your previous project. Now you're operating here, okay? So you're operating at the intersection of options and equities. So these are equity option markets that you're dealing with. So these are all the equity option markets that you are concerned. You're looking at 20 equity option markets. So in terms of who writes these options, this is just like any market. In equity options also you have market makers, okay? Some very big market makers are like Virtue Financial, then Citadel. These are all big funds and market making firms. They are quoting prices and options. There's also people who want to, you look at an option order book, okay? There will be people who want to buy and sell options, so they will be putting in their orders. So through those bids and offers that people are putting in, the option market is being constructed because you have prices to buy and sell, and you can transact at those prices. So basically, it's just like no different. An option market is no different from any other market, okay? If you're trading steel in the spot market or in the forward market, it's the same kind of situation. You have a bunch of players who have an interest in the particular asset and they're putting in prices to buy and sell. And some people are quoting, the market makers are quoting two-way prices. And that's how you have a market. Does that answer your question, Siddharth?
Yes, sir.
Okay.
Sir, another question. So can they also construct another type of derivatives which are more complex, like for example, which have underlying securities which are more than one, or where they derive value from another kind of security? Is that also possible, or is it also decided by exchanges?
Yeah, see, there are now, as you can see here, see options can trade. You notice under above options, I have put both. Now, I haven't had time to cover this with you guys, but I've given you the notes. You can go through the notes. I think your notes cover these things, right? I've given you notes for OTC markets, exchange traded markets. Yeah, these notes are available with you. You're supposed to read all of these. Okay, the entire set of notes. So if you read this, you'll find. So options are both. Options can be OTC as well as exchange traded. Okay. So therefore, in this case, you guys are trading US equity options. Those are generally most of the volume is in exchange traded markets. Okay, you can also have OTC markets for US equity options. Really can't control that. That is between two parties. Okay, so yeah, it's what was the question, that whether it is set by exchanges? Who? What was the?
About the derivatives, like there are options which have single underlying securities. Are there more derivatives which are more complex, like which derive value from another kind of securities, and also there are more than two of one underlying security?
Correct.
Is that also possible?
So more than two, you would have like basket options. Okay, so there are things called basket options where the underlying is a basket. Okay, so these things you'll find in my book on derivatives, which is there in your finance reference. There you will see some discussion of basket options. But yes, that is possible. Okay, so you would have some kind of underlying. Okay, the underlying might be one unique asset like this. Okay, technically, actually, this is a basket option. Okay, in some sense. Okay, so this is an option on a fund, but this is basically trading as an underlying asset on its own. But you can also think of this as an option on a basket of stock, but you can also structure the basket option in a slightly different way. Okay, but you can have more complicated underlying arrangements. Okay, where you have options on a basket of underlyings. Okay, instead of just one underlying. So, and well, different underlying, there's no different underlying. There is some underlying basically. So either underlying is one in a unique asset or it's a basket of assets. So you can have that, yeah.
And sir, from it can be from all of the asset classes, like currencies, commodities, and
Yeah,
debt also.
yeah. You can have an option on a basket of, let's say, combining dollar yen, the oil price, then the Nikkei 225, and then you can have maybe the Japanese government bonds. Okay, you can have like, so sometimes there's basically, sometimes you have I think I mentioned this also in my book. So sometimes you have basically a best of kind of option. So you will get the best of all these four. Whatever is the best performance, you will get the return on all these four. So you can structure all kinds of complex options. Okay, but the basic logic will remain the same. The basic pricing and hedging logic will remain the same. Evaluation and hedging logic will remain the same. But you can have different kinds of underlying. Yeah.
Okay, sir. And sir, about the expiry dates. In the book, it was written that the expiry dates are set for the third week of every month. But sir, it's not true. When I log into TWS, the dates are very different. And also, sir, why are the options constructed for even for 2022 and 2023?
No. So first of all, expiry date, what is written in the book is not really correct. This is why I taught you how to. This is why you notice, because even in the book they are not that careful. You know why I said this? Why did I put up this kind of statement in general? Because whenever I know that the statement is not 100% true all the time, immediately I have to put in this kind of a hedging statement. Actually, the book should have written this, but they did not write this because the book is written by people who don't trade options. So what is the reality you can see here? Okay, that yes, there are certain setup. There are some major expiry dates. Okay, which is the third week. Okay, the third whatever that you can look at the exchange website and see where it is. Okay, but there are also weekly expiration options. Okay, you can see 6, 13, 20. They also have weekly expiration. So there are, the way you should think about it is that there are multiple expirations available depending on the, sorry, I just was getting a sip. Yeah. There are, you have to think of it in this way that when you go into a particular market, okay, and the situation in the US market may be different from the situation in the Japanese market. So when you go into a particular market, you will have certain conventions that are there in that market, and they will basically, generally it would mean that there will be multiple expirations available to you, okay, and depending on the liquidity of that market, like the Indian markets are not liquid, so compared to the US markets, Indian markets are not that liquid. So in a very liquid market, you will be able to see high volume figures. You see that this is volume and open interest. You will be able to see high volume figures even in the long dated maturities. Okay, this is a completely a function of liquidity. So there is no guarantee on either front. There is no guarantee that you will get so many different expiration dates, and there is no guarantee that there will be high volume in all the dates. These are all a function of, okay, what is the institutional arrangement, what is the regulatory exchanges and all these people, the regulators exchanges, what have they decided, what are the conventions, and then you can list the option, but you can't force the liquidity. So the exchange can list this option, Jan 21, 2022, but the exchange can't force people to trade a minimum of 100 contracts in this expiry, okay, for this expiry. So they will list the option, and then how much volume there is, that's a function of investor interest. It's a function of liquidity, basically, right? So does that answer your question?
Yes, sir. So there is this thing about the cycles, like January cycle, February cycle, or March cycle. I couldn't get that. What is that?
Yeah, cycles are these are,
Like,
no, you can see the options here, weeklies in the near months, they will have weeklies also. You see, because November is nearby, so they have weeklies in November. Okay. Now, March 2021 is not nearby, so they don't have weeklies for March. Okay. So these are the cycles. These are November cycle, January cycle. I don't know where you saw that term, what is the context, but I would imagine this is what it means.
sir, it says that stock options in the US are on a January, February, or March cycle, and the January cycle consists of months of January, April, July, and October.
Yeah, those are okay. So those are they have certain cycles which I don't think you need to worry too much about all this, because these are aspects of what we call context. Okay, contextual knowledge. So this is generally what you should understand from a conceptual point of view, is that in any market there will be some conventions, okay, as to what kind of options are listed, which expiries are listed. So what you have to remember is what I just taught you, that there is a convention as to which expiries are listed, and then market liquidity determines the actual volume in each listing. Got it? So don't worry about so much about what is the convention. We don't need to learn about all those things. We don't need to memorize all those things. What we need to understand is that in any market, there will be some conventions, and that you can see from your quoting software. Like here, you can see this is a quote software. You can see what expiries are available. And as far as what volume is concerned, how much volume is there in a particular expiry, that is determined by liquidity, which is basically the investor interest and the market maker interest. Yeah. Does that answer your question?
Yes, sir.
Yeah.
Yes, sir, it does.
So
Sir, another question. I have another questions about the adjustment in price for the stock splits and dividends, and also about the flex options. You can answer that.
yeah, so adjustment of strike means they have that is again a mechanical aspect of it. That when there are stock splits, when there are dividends, okay, there is a theory that after the dividend, the stock price must fall by this much. So they will adjust the strike. So the exchange has certain procedures. Again, these are things which you can't do much about. Okay. So generally the theory is obviously that if you have a dividend after X, when the stock goes X dividend, the price drops by a certain amount. Okay. So they may adjust the stock. They may have certain, the exchange will have certain rules for how they are going to adjust the strike prices in response to that. More important in the case of stock splits actually, okay, where you have certain high price stocks when they split the stock. So the exchange will have certain conventions, but it does not affect your trading of options unless you have a particular position in that option or something. But in general, as you learn option trading, these are all factors which basically what they do is they adjust the strike prices. But in terms of your trading, it doesn't affect your trading, because what you are going to do is you are going to take a view on the option underlying asset, okay, at any point of time. Now, if this was split, okay, say I think which one, who did the split just now? I think Apple did a split. What is the price? Yeah, so Apple did a split. So price was earlier much higher per share. Now it has come down. So it doesn't change. For me, I'm just looking at the chart. I'm not even concerned with the actual price. Okay. That I have to read off later. So it doesn't affect your trading so much, because you have to still form a view on the underlying asset, and you have to form a view on the eyeball. You have to take a view on the eyeball, okay, which does not change. Whether so these things happen when there are some changes. It's like stock splits and all. They will just adjust the strike prices to, basically because they have to maintain orderly trading and etc. The trading has to make sense. The strike prices have to make sense. You can't have $1,500 strike prices when the market is trading at 120. Okay, so you will have to bring down the strike price to something in relation to that, to the new price of the underlying. That's what it means. So again, I would say no need to worry too much about that. You should be aware that that happens. That's it. Because anyway, you can't do much about it. They are not going to ask you what do you want. They will decide what is to be done, and they will adjust the strike price. But you will keep on trading by forming views. And what are the other part you asked? Second part?
About flex options.
Yeah, flex options are basically where you have flex. You read that in the that's part of your reading for under the in the Hull textbook, right? It's mentioned.
Yes, sir. Yes, sir.
It is even there in my. If you read my, I think you have not read my note on OTC markets. If you read these four notes, especially this part, you will see what flex options are an example of, kind of halfway between here and there. Okay. So flex option means basically options where you have certain flexibility in terms of contract terms. Generally, in exchange traded markets, you don't have flexibility on contract terms, but flex options give you some flexibility. You can choose the strike, you can choose the expiry, and all those things. This is just a way to, um, give people the best of both worlds. This is an example of where exchanges are trying to, uh, you know, build in some customization into their products to appeal to customers who are looking for that customization. Okay, that's basically what it is. So flex option.
Are these notes different from the IBM ones? Because I did read all the notes from the IBM course.
Yeah, so you guys should read all the notes. Actually, I've given you all the notes. You should read all the notes. Some notes were right.
about this OTC notes and exchange rate markets, are these notes different from the one you gave us in IPM?
No, no, these are the same notes actually, the same notes. But you should read this now. Actually, I'll just tell everybody to read these notes. You should, because this will help you to understand many of these questions which are arising in the case of option trading. Because options generally, the options that you guys are trading are exchange traded. But as I have shown here, these options can also be OTC. Okay, there's nothing that forces them here. They can also be here. So like these FX options are, most of the volume is OTC. Okay, there is exchange ET also, but it's mostly OTC. So yeah, so you should read those notes also. You read the notes here. Okay, that will help you to understand. And flex options you will get from the book, and from my notes you will be able to get an understanding of flex options.
Okay. So one last question about sir margin requirements. Like in the book it was given. So sir, does that matter? Do we have all? Do we have to read that? Because if we are writing an option and uh, we have an obligation to the sell the shares to that person if he exercises it.
Yeah. So in this case, I think U.S. equity options you will be paying on a you will be paying upfront. So if I have given you the reading, you can read it. I don't know if it's there. Is it there as part of your reading from here to here?
Sir, yes, sir. From chapter 10. No, no, it's after the flex options actually. Margin requirements are after the flex.
No need to read it. No need to read. Follow only what I've given. Just read the material that I've given. Margin requirements will not apply here, I think, because anyway, when you buy options, you will have to pay up. There are certain types of options which you can buy on margin, but here I think you have to pay up straight out. So if you buy an option, like say you buy the 200 call for 1829, 1829, you have to pay 1829 plus commissions. That full amount you have to pay. So there is no question of margin. If you are short options, then you have a margin problem, in the sense that if you are losing money on the option, then they will ask you to pay up more money. So there is that element of margin over there. Okay, but that again you can't do much about. Okay, it's just that you don't have to separately track, because you're anyway tracking the PNL on your option position. Okay, so you know you're losing money. Okay, so when you lose money, they'll make you pay. That is the margin requirement, that what you have. And then there's another type, which is some options can be bought on margin. That is, instead of paying 1829, you pay a percentage of 1829. Okay, but that is not applicable in your case, because in these US equity options you have to pay in full. This is called stock type settlement. Okay, if you read, there is another book that I've given you for option trading, which everybody should try to read. I have referred to certain part. I will refer to certain. There's a book by Sheldon Nattenberg, which is in your finance reference. Option trading and volatility. I'm trying to forget. Trying to remember the full name of the book. I don't know. Just read the book by Sheldon Nattenberg. Okay.
Okay, sir.
Yeah. Anything else?
No, sir. It's just that are we also gonna learn about other asset classes and other derivatives also, because the time is very less in every course, and then next course it's gonna be IFM, where we are gonna learn about risk hedging and all. So, sir, there is so much to learn and so less time actually.
Yeah. So obviously you will not have. No, you're asking about which ones?
Sir, like about futures, forwards, and swaps, other derivatives, and also about other asset classes. Like we have only traded in equities only, and not on debts, and also not on commodities,
Yeah.
and also not forex.
When you do your IFM project, that will cover currencies, commodities, and interest rates. And there we will cover futures. And I don't know if we'll have time to cover forwards and swaps. But this is the nature of the subject, because you can't, in 3 electives, you can't cover the body of material that exists in finance. you can't cover it in 3 electives. And especially since we are starting from scratch, like I have to start from what is the definition of a market, what are asset classes, markets, because this is, so 3 courses is too little. So therefore, there is going to be a problem in the sense that many things I will not be able to cover, because also I have to also remember that when I'm covering something, I can't just cover it at a high speed and go on. So I have to make sure that people understand what we are discussing. At least the basics, I have to ensure that people can figure out the basics. So therefore, we have to move at a certain relaxed pace. And so it's almost inevitable that we will not be able to cover everything. So you're right in that, but that's the way it is in terms of the curriculum. We don't have the time. We don't have the time. So we have to look at maybe a restructuring of the curriculum, but I think those are very radical ideas actually. So at this point of time, it will be very difficult to implement. So the way it works is that I will teach you some of the basics, okay? And then I will tell you what else. I've given you many reference books. Then I've given you certain notes. And then I will give you some pointers as to how you study the rest, okay? And so you'll have to do self-study for the rest. So that's how it will have to work, because we don't have the time.
Sir, we have, sir, 2 majors. Like for marketing, we have also so much to read. And sir, how did you do it in your time? Were there 2 majors? Like, because marketing also takes up a lot of time to read and solve the articles, read chapters, and then there is so much less time to read about the finance, which is the core.
Yeah, I'm not a fan of these 2 majors business, but this is what the institute has decided. Because I think that people should go into deep specializations. The thinking was that 2 majors, gives students a bit of a hedge, in the sense that suppose you don't get a job in finance, then you have marketing, and then you can go and get a job in marketing. That is the thinking behind it. So there's a logic to that. But I think that that's not a very good approach, because you are not developing depth. But anyway, that's what it is. So we can't do much about that. So what we have to do is this, as I told you, I will teach you some of the basic stuff, and I have to go at a relaxed pace, because I have to make sure that everybody understands the basics. And then I will give you some material, I will give you some guidance, and hopefully with those basic principles, you can then take the extra material and read it on your own time. And I will give you a basic roadmap. So this is like a roadmap. These are all the things you have to learn about. All the major asset classes, ET versus OTC, okay, major instrument types. So this is your roadmap. And I can travel with you only part of the way. The rest of the journey you have to undertake on your own, right? So forwards, FOPs, I think you'll have to do on your own, because we won't have the time. So that's this is just a reality. I mean, we can't do much about it. Yeah. Does that
Thank you.
answer your question, Siddharth? What happened? Siddharth has left.
No, sir, I'm saying thank you, sir. I got it.
All right.
Got something.
Any other technical questions? No more? Okay. So let's go to Shaurya now. I'll just stop the recording.